Hello and welcome back to All Things Money. I'm your host, David Blain. During today's show, we're going to focus on a broad-based principle that I think will help all investors out there to become better investors. And it's the principle of focusing on how to not lose money and not so much focus on how to make money. And as I alluded to at the end of last segment, we're not talking about taking your money and sticking it in a bank, in a savings account, or putting it under your mattress or burying it in the backyard. We're talking about investors that have a reasonable understanding that, to make money by investing, to have your portfolio grow, that you have to invest in, stocks and bonds and real estate, commodities, things like that out in the marketplace. And so, but when these people take their money and they go out into ventures, they try to make some money. There's a lot of times they're so focused on making money that they don't realize some of the risks that are involved. And I'm here to suggest that when a good investor is someone that focuses on how to not lose money as much as the reward. And what do I mean by that? Every year there's a company called D.L. It's D.A.L.B.A.R., and you can Google it, look it up. But they do a study every year of the individual investor behavior and how well they are doing with their investments. They get the data from all these brokerage firms, and they're able to crunch the numbers. And what they see is, for example, in 2011, the S&P had a total return of about 2%. The average equity mutual fund investor lost 5.73%. 2010, the S&P rose 9.14%. The average equity investor had a return of 3.8%. So investors typically trail the benchmark anywhere between 5 and 10%. And why is that? It's simply because most investors end up buying high and selling low, and they don't learn anything from that experience. The typical investor only holds a stock mutual fund an average of 3.27 years. Bond investors are no different that own diversified portfolios. And these investors, they describe themselves as long-term investors, but their behaviors act like very bad traders. And so they get caught up in the greed cycle. When things are going up, they get greedy, and when things are going down, they get caught up in the panic cycle, and they get out of rhythm with the natural cycle of the markets. 3 to 5 years of bull markets and bear markets, and they're completely out of sync with this, that they end up buying very high and selling very low. And so I've been fascinated at how investors behave and how the markets work and things like that. And I think that, when people make a mistake, if their house gets robbed or something like that, they learn from that, and they get a burglar alarm, or they get a dog, or, if they have an auto accident, maybe they take a safe driving class. Well, investors, when they invest, it seems like when they make a mistake, they double down on it. And they seem, intent on making the same mistakes over and over and over again. And so good investors, in my opinion, are always looking for ways not to lose money. And just as an example, if the market goes up and down, stock market goes up and down, and over time, and it's random on a short-term basis, but you have a kind of a good feeling that once every several years you're going to have a major decline. Every year the stock market has a decline between 10 and 15%. It's a fact. It happens. And so people, if you have a good understanding of it and you realize that instead of trying to make those timing moves of getting out of the market and getting in the market, which is where most people end up losing out, is to focus on how to not lose money. And having a diversified portfolio is one of those ways. People a lot of times try to pick the next Google or the next Apple, the next Microsoft, whatever, ExxonMobil, and they're trying to pick the next individual stock. And that's, once again, focusing on, they're stretching on how to make money, and they don't look at the fact that, well, a company has the ability to go completely out of business. WorldCom, MCI. And I should know, when I first started investing, we used all individual securities. 15, 20 years ago, there was a case that I would make that it was a different time in investing, and you didn't have companies going out of business, at the snap of a finger. And today we all use all exchange-traded funds, index exchange-traded funds. And so once again, focusing on how not to lose money by looking to the safety and security of diversification. Both in the U.S., instead of trying to pick out, the 5 or 10 good companies that you think are going to be successful, that we would say, invest in the entire market, invest in the entire U.S. market. Warren Buffett kind of, as much good as he says to people and the principles, he's done a lot of harm because people think they can be Warren Buffett. But if you really listen to him, he says that for the average investor, and by average, I should say for even the extremely smart investor, because they're even average, is that they should buy index funds. That's right from Warren Buffett. So it's very difficult to try to use individual securities. And so that's one principle there of focusing on how to not lose money instead of focusing just on how to make money. People think that they can pick the next great stock and make a lot of money. Instead, we would say focus on how to not lose a bunch of money in the stock market and allow the market's natural returns to help your portfolio grow. Well, that's the end of our second segment. When we come back, we'll continue focusing on this topic of how to not lose money to allow your portfolio to grow.